welcome Sabina from CBRE Investment Management. I look forward to having an open debate with you as we go through these slides. And just to warn everybody on the call and those of you watching a recording, this is going to get very technical, and I can't make apologies for that. It is all about the algebra, and that's what we're going to be going through pretty slowly in detail about repricing. And everybody is telling me at the moment that there's a huge bid-offer spread between potential buyers and potential sellers of real estate, not only in the UK, across Europe, in the US, globally. There's this standoff between buyers and sellers. And our point, I think, is going to be that that's not so surprising, because things are shifting. Things have been moving in not just a small way, but in a very, very big way for 18 months now. And the market is in a state of some confusion, which is not surprising. So we're going to go through the algebra and try and understand what it is that's changed and what it is that hasn't changed. So, when I'm talking more to a broad audience these days, I'm telling people that there are four big things going on in the world, which are really affecting real estate investors and strategists and decision makers, investment committees. The first one is the constant of demographics and geopolitics. So things like, the new tripolar world against the previously globalizing force that we were enjoying up to 5 years ago. Demographics, meaning the massive changes in particularly age profiles in some countries. We've got the impact of climate change and sustainability in its broadest sense that we're all struggling with. We've got the impact of property technology, or the fourth industrial revolution, which is impacting on the real estate market. In particular, started with retail, and it's now affecting the office market. And now, on top of all of this, we've got the unwinding of quantitative easing, which started, let's say, 18 months ago, and is having a big impact on the real estate market. Now, change is generally slow in property markets, and all of these factors are having slow but measurable impacts on the real estate market. And the QE unwind is no surprise. I think it's fair to say that ever since 2008-9, we've been expecting an increase in interest rates at some point. So we've had very low interest rates since the early 2010s. We've been expecting that to be reversed at some point, and it's suddenly happened. And so this is not a completely unanticipated event, but it's something that's happened very quickly. And we're now into this new regime of higher interest rates, which is in combination with all the things that have affected the retail market, the office market, climate change, technology, and so on. So we've got this sort of perfect storm that we're trying to deal with right now. Now, here's the algebra. So first of all, the first thing to say is that the value of a piece of real estate can be represented as the rent divided by a cap rate. So to maximize real estate values, you want to maximize rents and you want to minimize cap rates. We've been going through a period where cap rates have absolutely been minimized. Cap rates have been at the lowest level that I've ever seen in 50 years of studying real estate. So that in the UK, we got used to the idea that a really good office building would sell on a 3.5% cap rate, which means somebody is paying between 30 and 35 times rent to buy that building. Cap rates in parts of Europe, continental Europe, have been even lower. So we got used to 2.5%, 2.75% cap rates in German office markets, for example. Paris has been trading at very, very low cap rates of around 3% in the office market. So we're used to extremely low cap rates. Now, we also need to introduce a second piece of algebra, which is Gordon's growth model, or the dividend discount model, which simply states that the cap rate on anything is a function of the required return, the IRR, if you like, less the amount of growth that you expect to get out of the asset. So if your required return is, let's say, 5%, your IRR, your long-term return requirement is 5%, and you think rents are going to grow at 2% a year, then you'll be happy paying a 3% cap rate. Now, we're going to expand that out. So we expand that out into the third line on this slide, which is that the required return can be expanded out into the nominal risk-free rate and a risk premium. Now, the nominal risk-free rate is usually assumed to be some sort of government bond yield. We could use corporate bonds as arguably a better proxy for real estate, but let's start with government 10-year bond yields, which in the UK 18 months ago were as low as about 1%. And then a risk premium. So how much more return would you want? How much more IRR would you want to buy a portfolio of real estate assets if you could get 1% on a portfolio of government bonds? And, you know, argument tends to settle this at around 3%. Of course, there are always arguments for it being more or less, but on average, we've got comfortable with the sort of level of about 3%. So that means that 1% plus 3% gets you to 4. That 4% is the total required return you'd want for a portfolio of high quality real estate 18 months ago. And it's a low number, you know, it's the lowest number I've ever seen. You know, 4% IRR is as low as I've ever experienced. At the end of the third line of this formula, we've got the growth component. And the growth component for real estate is slightly more complicated because buildings wear out over time. So the function, the net growth function, is the rate at which rents for new buildings grow over time in response to demand and supply, and the rate at which buildings wear out over time through deterioration, obsolescence, depreciation. And so G minus D, if you like, is the net growth function. If we're putting it into the cap rate formula, then minus G plus D gets us to where we need to be. So let's say that we think rents are going to grow with the rate of inflation in the UK long-term 2%, but we think that buildings decline in rental value at a rate of 1% a year. Then we've got 1% net growth in a portfolio of office buildings. So if we were to plug all those numbers in, we'd get to, let's say, 3.5% cap rate, where we've got a 1% government bond yield, we've got a 3% risk premium, we've got 1.5% growth in rents, let's say, driven by inflation, and we've got 1% depreciation going on in the office market. That gets you to a 3.5% cap rate for a London office building. So the rental growth of 1.5 in there is slightly below the rate of inflation. That's historically what we've seen in the UK. We've seen about -0.5 real rent growth. So with a government target of 2%, we'd expect slightly less rent growth for brand new buildings. And then we get 1% depreciation, gets us to that 3.5. Now, if your brain is hurting so far, I'm really sorry, but I'm going to make it even more painful in the next line. So the next line is we expand this out again. And now we're going to expand out the nominal risk-free rate. So the nominal risk-free rate, according to Fisher, 1920s, and financial economists since, the nominal risk-free rate is a function of the real risk-free rate, which is the rate which you would return, the return you would require if you were to invest in a completely risk-free asset where it was completely inflation-proof. So you've got no risk of default, and your income stream is going to be perfectly matched with inflation. What return would you want for an asset like that? And actually, you know, we've got assets like that. We have index-linked gilts in the UK. We have TIPS in the US. So governments do issue these investments. And the return on these investments up to 18 months ago was something like -2. So the return on British index-linked gilts up to about 18 months ago, a year ago, was about -2. Now we had a government. The next thing that you'd need, though, if you want to buy a fixed interest bond from a government, you need to cover the rate of inflation. So let's say people are happy with a -2 for this completely risk-free asset in real terms. You then need to be paid for inflation. The government target was 2%. So that means that you get to about 0 as the net function of the real risk-free rate plus expected inflation. But bond yields were trading, fixed interest government bond yields were trading at about 1% a year ago. So where does that extra 1 come from? Well, that extra 1 comes from an inflation risk premium. If you are going to buy a portfolio of fixed interest government bonds, you're taking a risk that inflation takes off to a level which is higher than you want it to be and leaves you with a negative IRR. So investors need an extra risk premium for buying these fixed interest government bonds. And let's say that number a year ago was about 1%. that gets you to your 1% 10-year government bond yield, -2 real risk-free rate, +2 inflation, +1 inflation risk premium. Now, what risk premium would you want if you bought real estate? So you start from a real risk-free rate, we then go to a nominal risk-free rate, so we go from -2 to +1. What would you want if you bought a portfolio of real estate? Well, we're talking about a 3% risk premium, as we did earlier. That gets us to about a 4% required return or IRR for a portfolio of real estate. If we go on to the right-hand side of the equation again, then, the net growth component, we're comfortable with the idea that rental growth is a function of inflation because we're comfortable with the idea that real estate rents seem to rise at about the rate of inflation minus a little bit, let's say minus 0.5%. So in the long run, we think we get inflation delivered through the rent stream, but less a bit, so -0.5 real rent growth. And then we'll get inflation added on top of that. So the net rent growth that we're beginning getting is about 1.5%, as it says above, and that's a function of 2% inflation minus 0.5 real rent growth. And then we add the depreciation on top, the extra 1%, and we've got a net growth function there of -0.5 +2 +1, which is 2.5%. Sorry, I'll start again. It's -0.5 +2, that's 1.5%, less the 1% depreciation gets us to 0.5% real rent growth. So we've got a required return of 4%. We've got net rent growth of about 0.5% after depreciation, and that gets us to a 3.5% cap rate. So if in the market we're saying the correct cap rate a year ago was 3.5%, then if we were to be offered an office building on a 3% cap rate, we'd say no thank you, offices are too expensive. If we were offered a building on a 4% cap rate, we'd say yes please, offices look cheap. And the market is pricing at this 3.5% level based on my idea of these inputs. Now, what happened a year ago is that UK government 10-year gilt yields went from 1% to 3.5%, very, very quickly. And they're touching 4 right now. So this is what I'm calling QE unwind, the quantitative easing unwind. It's the end of very cheap money, and it has an immediate impact on the property market. So what do real estate investors talk about when gilt yields go from 1 to 3.5 or 4%? Well, at the same time, short-term interest rates have risen a lot. So gilt yields tend to be medium to long-term investments, but very short-term interest rates are also going up. And real estate investors are pretty much fixated on 5-year borrowing rates. A typical real estate investor will borrow at some sort of flexible interest rate, but the bank he's borrowing from will ask him or her to switch that into fixed rate money, usually a 5-year swap. And 5-year swap rates, as we can see from this chart, from the green line, the bottom green line, have gone from pretty much 0.5% to pretty much 4% in a year. So this is the first real red flag for property investors. It's got nothing to do with my algebra, if you like, but it's a real red flag for investors because they were borrowing money at, let's say, 2.5%, including a margin, a year and a half ago, and now they're borrowing at 6%, including a margin. And that's going to make them much less interested in paying high prices for real estate. So if interest rates rise, the cost of borrowing rises, it means real estate becomes less attractive to a leveraged buyer. But what's much more interesting to me is not the swap rate, it's really what's going on in the bond markets. And I'm getting ready to introduce Sabina, just to give Sabina a bit of notice and to give you all a bit of relief that I'm going to stop talking soon. But this is what I'm really interested in. This is the 10-year gilt yield over time compared to real estate yields. And I'm using UK data. It's not particularly different in the UK to anywhere else, but I'm using UK data just so you know. So the red line is property yields, which you can see have been drifting down from pretty high levels in the mid-80s to lower levels by 2022. These are equivalent yields, which are, it's a slightly technical definition, but we've had average yields going from 8 up to 10 and down to just below 6 in the UK in the last 20 odd years. At the same time, we've had 10-year gilt yields. This is the 10-year government bond yield, the fixed interest bond yield, the one that was trading at 1% up to a year and a half ago. We've had that constantly falling from levels of 10 down to about the 0.5 to 1 level, and then popping right back up again to 4% in the last 12 months. Now, we know that the algebra underneath this particular interest rate, the nominal risk-free rate, is these three components. It's the real risk-free rate, expected inflation, and the inflation risk premium. So the question is, given this rise here, this significant rise, which of these components, the real risk-free rate, expected inflation, or the expected risk premium for inflation, which of those has changed? And arguably, all of them have changed. And they're going to have different impacts on the real estate pricing equation. Now, if you look at the component of that nominal risk-free rate, which is the real risk-free rate, if we look at government indexed bonds in the UK, you can see that what they've been doing is constantly falling through this period of QE. Since 2000 and let's say 2009, we've had this collapse in the real yield down to negative levels, -2, or even worse than -2 by 2021. And what I'd like to point you towards is this series of grey bars towards the end of this line. We've got property yields, as before, floating along at, just below 6% for the average property at this top line here. But we've had this real risk-free rate collapsing underneath it. And the result has been a much bigger available risk premium, these grey bars. It means you're getting more return than you expected to get previously for buying real estate. You're getting over-rewarded, if you like, for the risk that you're taking. And this is an important component here, because one of the questions we've got to answer is there enough room in this property yield here to cope with a rapid rise in real risk-free rates? Because the algebra is very clear, a rise in risk-free rates will increase cap rates. But we've got this big cushion that we've got used to for the last 10 years. So it may be that that cushion is enough to prevent a big collapse in real estate prices. And if you look at the short-term average in this premium, it's about 6 to 7%. Historically, before 2006, the GFC, it was running at more like 4%. So it may be that we've got this 2 to 3% cushion, which allows real risk-free rates to go from -2 to 0 or +1 without massive damage to the property market. I think that's one of the things that we need to think about. So Sabina, I'm just going to go through these one at a time, and maybe if I stop at every line and you come in and tell me what you think. So here's my equation. Here's my equation, and in yellow, I'm changing one variable at a time, and let's see whether we think this variable has changed. So the first variable is the real interest rate, and the graph I just showed suggests that the real interest rate measured by index-linked gilts in the UK has gone from -2 to, let's say, 0 to +1. That's a pretty challenging thing to happen for pricing of all assets, but we've got that premium that gave us a bit of a cushion, Sabina. What do you think?
I mean, arguably the supernormal period was the one before, when real interest rates were sort of, -3, -2, and reverting to 0 to 1 is arguably far more healthy for allocation decisions, and having money be free in real terms for an extended period of time, you could argue, is what contributed to all sorts of asset bubbles and mispricing of, private equity, not just in real estate. So it is more challenging, but I think people have to get their heads around that this actually is probably the new normal. And going forward, if you think that you're going to have a nominal bond somewhere between 2-3.5-ish%, wherever you are in developed markets, and inflation at about the same rate, I think 0 to 1's kind of what you have to factor in for the next 10 years. As you know, I've got a strong belief that we are at a monetary policy turning point, an inflation turning point. And it's not that I think the new normal is disastrous. It's probably quite similar to when I was entering this industry in the early 2000s. But that is probably what we should be assuming going forward, not -2. So I'd whack a 1% in there if I were doing some underwriting going forward.
Right. Okay, that's great.
Opinions differ, right? I mean, I do have a particular view that we're entering mildly more inflationary structural times.
Right. Okay. Well, that's great, because so if you're clear that this -2 real yield is going to go to +1 and stay there, then the only way we can cope with that in property pricing is if this risk premium here is 3% higher than it needs to be. So that move upwards, that 3% move up in real yields, is not going to kill us as long as we've got a 3% cushion in this risk premium here. And it looks like we've got two-ish. We've certainly got two-ish. If you move from these long-term averages of 4 up to long-term averages 6 to 7, we may even have 3. So, you know, we could comfort ourselves with the level of this risk premium that we've been enjoying. We've been dining out. We've been feasting on this excessive risk premium for 10 years, and that's why we've had such great markets. You know, that's why it's
I mean, that's led to supernormal return, right? And I think that it's a story that I have myself been guilty of peddling over the last 7 years, that it's wonderful, isn't it? This excessive risk premium. It's why people have allocated into real estate from fixed income, from other asset classes, why allocations have gone from 8 to 10% to 15 to 20%, because people have been rent seekers in the multi-asset meaning of the word rent. They have gone to where the supernormal profit was. It's kind of, in a way, amazing it wasn't competed away more, as much as people like us who've been in real estate for a while saw cap rates fall and fall. Actually, that chart shows that they could have fallen further, right? They could have fallen further to, if we were in a perfectly profit maximizing efficient market, that should have fallen back. And the way in which you could justify it, if you want to be kind to those of us in real estate, is to say, well, we knew it couldn't last and we didn't compete it down. So you could make that argument. I don't think that's really the case. I think what I was guilty of saying to a lot of clients the last 7 years is, isn't this wonderful? Because as bond yields rise, the property yields will not have to rise commensurately. They won't have to be pushed up because of this supernormal income premium. And I'm sure some people still feel that way. From my perspective, you should need a higher risk premium to be in an asset class where we know that in this particular next 5 years, we're going to have to pay an awful lot of money to get our house in order from a depreciation, functional obsolescence perspective, whether that's because of ESG regulations or behavioral change and getting our stock of assets fit for purpose. So the question is was that income premium already so wide that it can absorb both the higher interest rate and the higher capex and functional obsolescence of those buildings? And that's, I think, where the debate is, and I'm not truly sure.
No, I agree. So it's not, you know, there's a sort of set of factors that are hitting us, and we've got to decide where to put them in the algebra at some point. But for now, let's leave us with the potential comfort that rise in the real risk-free rate could be less than fatal, because we've got that comfort level of risk premium. And I think your point was a really good one, that cap rates could have gone down to 2% for prime London offices if people had not been worried about this reversal of real risk-free rates at some point. It could have happened, and it didn't. So
yeah, because people underwrite for 10 years and they would have had some exit cap rate with some higher bond yield, I hope. So yes, let's give ourselves some credit for figuring out this wouldn't last forever.
Absolutely, there has been some discipline. Okay, so the next factor in the equation is inflation, expected inflation, and you see it appears twice. Okay, so the great thing about real estate is that if there is some correlation between inflation and rent growth, then we don't have to worry too much about changes in inflation, because we hope that it comes through in the income stream. We hope. Now, you know, we can challenge that, I'm sure we will. But the first point to make is, just because, and inflation has obviously risen, you know, expected inflation has obviously risen, certainly in the short term. So that's got some implication for long-term inflation expectations. The good news is that given that it has risen, it's not fatal to cap rates. It doesn't mean that it passes straight through to cap rates, because if you need an extra 2% return to cover 4% inflation, hopefully your rents will grow at 4%, not 2%, because they are somewhat inflation linked. So your IRR, your expected IRR goes up by 2% because you're getting 2% higher rent growth. Your required return goes up by 2% because bond yields have gone up by 2%, the risk-free rate's gone up by 2% because of the inflation component. No impact on cap rates, everything's fine. What do you think, Sabina?
I mean, you'll know better than me. There's very little evidence that rents really do keep pace with inflation over the long term, particularly in a market like the UK, where we do have upward only rent reviews sometimes, but there's very little index linking in our leasing. And even when there is, you know, I think in theory people think these things work out, but as we're seeing with the residential market, where you should be able to capture inflation and changes in market rent, often people will intervene to stop the landlord taking a supernormal profit on that basis, or a normal profit actually on that basis.
So you suggested that the government might regulate to keep rents down, and that kills the ability of the landlord to pass through inflation.
Well, it's already happening in places. It's happening in Scotland and in municipalities in Europe and the US where that's happening. So I don't think there's evidence that rent pass-through really does come through to match inflation. And it probably depends why the inflation is there, right? So if the inflation is there because you've got really strong demand conditions, one might assume that that would be mirrored in very strong corporate profitability, and therefore the tenant can afford to pay more rent. And actually, you may be successful in pushing it through even without index linking. But if it's because of what we have now, which is supply constraint and persistent supply shock, I think you're probably going to be less successful.
Yeah.
So I don't take much comfort from the idea that higher inflation means my NOI growth is going to be super bouncy. Well, and especially if you think the first time in my career for the last 2 years where, you know, we're not seeing rental leasing performance consistent across sectors and across quality. There's such bifurcation by quality that I think that underlying structural change in the market swamps this sort of generic macro to rent link.
Okay, so you're going to be pretty lucky if your rents keep pace with this higher inflation rate, which is not great news. That means your cap rate should be going up because you're not going to keep pace. What about inflation risk premium? Do you think that's gone up, Sabina, given what's happened in the last 2 years?
Yes. So what's really interesting, I've been doing a bit of work on this, like looking back at really long run inflation in the UK. The Bank of England hilariously publishes data that goes back to the 1200s. But even if you just look at what happened in the sort of the post World War II period, it's quite unusual, both for inflation to have been as low as it was since 2008, but also as stable. The volatility of inflation, thanks to central bank inflation targeting and quantitative easing, has been very compressed. And I think that's less well understood. People get that interest rates were abnormally low. I don't think they get how unvolatile inflation was. And of course, that has reversed with a vengeance since the Russian invasion of Ukraine. And the question is going forward, when we get through this cyclical readjustment, do we go back to what we had before, or do we go back to something that's more akin to maybe the 80s and 90s when you had a lot more inflation volatility? And my feeling is that it's the latter, and maybe it's worse. And my principal reason behind this is there's two sources of things that can really make inflation jump around: energy and food. And we've seen the energy one with a vengeance over last year. Food price volatility, I think, is going to be the social, political, and macro risk going forward because of climate change and because of extreme weather events causing droughts, then flooding, disrupting food supply. You can see what's going on, and very sadly, in Emilia-Romagna at the moment. And I think there's more of that to come. It has huge implications. So to me, I would be putting in an inflation risk premium that was more akin to how people would have underwritten maybe in the 80s and 90s, not as bad as the 70s, but let's see, because I don't think we truly understand what that climate change impact is going to be. That's
a great point. It's pretty bad news because there's no way out of this one. If the inflation risk premium rises and we think that real estate isn't a perfect real estate inflation hedge, then we just have to take that one on the chin, because that higher risk premium is going to pass right through to cap rates, unfortunately.
Thing is, it doesn't have to be a perfect inflation hedge. It just needs to be better than the competitor asset classes, right?
Well, true. But in my algebra, Sabina, that number is going to cap rates, I'm afraid. Yeah. So we now move on to the property risk premium. So has property got more risky? So we've got these two things going on in my opinion. Very interested in your view on this. So on the one hand, we've got the idea that we've been having an excessively high available property risk premium delivered to us for the last 10 years. this idea that we've got 6 to 7 over index-linked gilts, and it's a bigger number than it used to be. Seems to be a pretty high risk premium that we've been enjoying. On the other hand, we're starting to worry about stranded assets. We're worried about the impact of carbon, technology, working from home, you name it, on big chunks of the property market. So has property got more risky? You know, first question. And secondly, how do you feel now about that cushion of risk premium that we've had? You know, do we still need that cushion?
Yeah, I mean, I guess I said it before. I think we do need the cushion because I think property has, at this particular juncture, got a lot of climate, technology, behavioural change to work and regulatory change to cope with.
Yeah,
I suspect the answer, however, is very different depending on the quality of property and the modernity of format. And that also probably applies to the expected inflation line as to whether you can get rents that probably are ahead of inflation.
yeah.
So I suspect there's a kind of very modern, very well designed, keeping pace with regulatory change building, whether logistics, office, resi, where you probably could get real rent growth and probably would accept a much lower property risk premium because you feel you've already taken that into account. You paid more for it, but that you wouldn't need that cushion. And then there's another type of format and property whereby none of, you know, these numbers would almost make it uneconomic to do anything with it. And that's the real problem facing the industry, isn't it? So I think in general, we do need that cushion. So we can't assume that that's going to absorb the higher bond yield, but it really depends on the format and it's going to be so bifurcated.
Yeah. Leads us on to the last point, which is the, you know, historically, the data I've got, that historically, going back as long as I can, it looks like real estate in most markets has delivered a negative real rent growth number. And it could be somewhere between -0.5 and -1. I've put in -0.5, which is the UK-ish number. Do you think that number is okay? Do you think it's too optimistic or pessimistic going forwards?
I think the answer depends on what proportion of the stock do you think falls into that legacy category and how fast you can start renewing it. Because there's a category, and you can see it actually, you can see it on the leasing performance of our portfolios and competitors' portfolios. When it is the good stuff, actually they are performing ahead of pro forma because it's so scarce to have that good quality. So the sort of the next 10-year answer to this question depends on how good you think we are at an industry at churning our portfolios. But I suspect if it was historically -0.5%, it's got to be higher because we've never seen this burden of, you know, in Europe in particular, in the UK in particular, this journey to net zero is going to disproportionately fall on the built environment.
So when you say it's going to be higher, you mean it's
lower?
A bigger,
Yeah. Like if it was -0.5, I don't know what it is. Is it a -1.5 or whatever? Yeah.
Okay. So if we pop that all together then into our cap rate forecast or expectation, I've got what I think was the situation 18 months ago, where we've got this London office building selling on a 3.5% cap rate, given everything that was going on. And I'm now trying to value that London office building in today's situation, where the real yield has gone up to, let's say, 0. You were pushing me towards 1, but let's be nice and say it's going to settle at around 0. We've got a potential increase in the inflation risk premium. And again, I've been nice and I've kept it where it was, although I can see why I'd push that one up as well. And I've actually pulled the risk premium down on real estate because we've had such big numbers going past. Let's say we don't need quite so much going forwards. I know you don't agree with me on that. I've got -0.5 real rent growth, which you think should be worse. And I'm afraid my cap rate's gone up to 5% already. From 3.5, even though I'm being nice on all those numbers. And the reason, of course, is because the real risk-free rate's gone from -2 to 0, and you can't do anything about it. You know, that's just going to pass straight through. So the only comfort that you can have is that risk premium of 6 to 7 above real yields was so high, we can afford to see that drop by 3%. But you know, it's hard to see it. It's hard to see it, and so I can't see why a prime London office building in London right now would sell for anything better than 5%. That's my proposition, Sabina.
Yeah, and as you were speaking, I was trying to plug my version of these numbers in, And I think I end up at a 7 to 8, which
Right.
I guess speaks to why in our model portfolios, we recommend a legacy office weighting of sort of 5% or 0 to 10. I mean, it's very low relative to benchmark and has been for some time.
So,
and I think
yeah.
it's going to take a while to get there, right? I mean, it took 10 years for retail to get from 3.5 to 8.
Yeah.
And still going, right? It started in 2014. It's still going. We're in 2023. So I'm not sure this happens overnight, but
yeah.
That doesn't seem, the bottom line of this does not seem implausible to me, even though my numbers underneath it might be slightly in a slightly different order.
Right. So my sort of bottom line here is we settle at 0 real risk-free rate. It could be a bit higher, but let's say we settle at 0. The inflation risk premium rises. It should rise. So let's say 1.5. The risk premium for real estate has probably risen because of global warming, working from home, all those things. So we've pushed that up a little bit. Real rent growth, as you said, you're less optimistic about real rent growth. So I've pushed that down a little bit to -1, and then we end up with a 7% cap rate. And that's a 50% value drop, obviously. For a given rent, that's a 50% fall in values. And I'm pretty convinced that there will be a lot of buildings out there that will fall in value by 50%. I think that's going to happen.
And by the way, that's what's happened in the listed market already. Right. If you look at the major office specialist REITs, that's the kind of fall we've seen. Doesn't mean it won't rebound.
Right. Exactly. Now, what's the good news, Sabina? What is the good news? There's only one thing left that could make us happy, and that's rents. So, given that values are a function of rent divided by cap rate, and we can't see a nice scenario for cap rates, the only thing that can save us then is if rents go up for whatever reason. So what's the good news?
I think the good news is what is always exciting about being at real estate. We're in charge of the built environment, and we have a unique and what should be an exciting challenge to transform it at pace over the next 5 years with absolutely accelerating technological advancements and actually material science advancements. You listen to I was hearing something yesterday about cross timber construction. I mean, there are ways to improve this, and I think when you have that good product, then you will see rents that are ahead of inflation because there's a scarcity of it, and there is still a demand for it, right? People still want to and need to be productive in spaces that enable that productive work, whether you want to call it whatever that office space looks like, whatever that residential space looks like. And then that's just the climate change. If I look at your demographics point here, we have an amazing generational opportunity to create good quality space for our senior population and for our student populations, and frankly, affordable, good quality housing if we want our cities to survive, given the fact that they're in the crosshairs. So the challenges are huge, but so are the opportunities. And I think if one really puts the tenant at the center of it and asks, what do they need from a behavioral perspective and builds it, I think you'll be fine on the rent growth. I just think that there are going to be radical winners and radical losers. And it will be a very unforgiving market for those who are just on the margin. I heard a talk yesterday from Jamie Palumbo, Lord Palumbo of Southwark, known to many of us in the UK of a certain generation as the founder of the nightclub Ministry of Sound, but he now does office and mixed use development. And he asked someone on the panel a very searching question, which is your office actually really good, or is it just a little bit better than a crappy legacy office? Because I suspect that what a lot of us are doing in our refurbs and redesigns, including ourselves, is making stuff that's just a little bit better than the general commodity office and isn't fundamentally transformational and meeting the needs of the future. So I think that's the searching question we need to ask ourselves.
Great, Sabina.
Is that positive? Is that positive? I feel it should be positive. I feel quite excited about it all.
I think I could argue that the positive thing. So there's a piece of anecdotal evidence and there's sort of logic. So logic tells me that we're going to see reduced levels of development, speculative development going forwards, because the equation, the residual equation for development has got worse. Either land values have got to drop, or there's going to be less development. It's just less viable. People can make less profit. So, we've got an inhibited supply pipeline coming down the road, and we've got all the issues about carbon and whether you want to use new building materials in new developments, which is going to limit that to some extent. The anecdotal evidence, and of course, a limitation on development is a good thing for rents. We want a limited supply against maybe a reduced demand, but a limited supply will boost rents. The anecdotal evidence is that in central London, there have been a small number of really high quality office developments produced by the market recently. And our experience of those is that when they're pro forma to let at £100 a square foot and they're going for £120 a square foot, they may take slightly longer to get away because people are taking their time. But once they decide that they want this office space, they're prepared to pay for it. And so it may be that we're saving ourselves a little bit by getting some higher rents on the top line for really good buildings, and that's exactly what you were saying, Sabina, that we get this bifurcation between really good assets that command really good rents. They may not command the same cap rates that they used to, but they're going to command really good rents, so they're going to deliver the IRR you want in the long run. But you're going to get this sort of semi-stranded asset risk but
that's also helpful, right? Like to get to say we've got the good stuff that's great and is scarce, and that will do well. And then you take the stranded stuff that most people are avoiding, but it's actually healthy. The mechanism by which those stranded office assets become lovely resi and mixed use and fit for the future is that the price falls to a level whereby it is economic for it to be redeveloped and or repurposed. Because at the moment, that's not an easy task, we know, right? The way that offices are done, floor to ceiling heights, the dark space in the mid, it's not an easy, cheap fix. You probably need to get to more than 50% price drop in that stranded office legacy stuff to tempt in the people who are going to transform it in an environmentally sensible way into what it is for the future. So on the one hand, it's scary. And I get that if we own it, it is very, very scary. Or if you're the bank getting the keys back on it, it's scary. But that is the natural, destructive way towards that we get to the future. So again, I don't necessarily see that as problematic. The only place I see it as problematic, actually, this churn, is when you get to markets, and maybe the US is going to turn out to be a good example of this, where the impact of that going through bank balance sheets causes something systemic in the availability of credit to the wider economy. It's never a good thing when commercial real estate is driving general economic credit conditions. But in the US, with the small and regional banks and their exposure to this crappy office, this could be an example of it. So I think we need to watch that as a general macro risk that could infect other sectors in the wider economy.
Okay. So on that optimistic note, we can move on, I think, to the wrap up. So thank you very much, Sabina. That was great. Much appreciate you doing this, and CBRE for hosting this session. I think it's back to you, Tindra. So I'm just looking at the chat and I'm looking at those questions, but over to you, Tindra, for now. We can come back and answer the questions perhaps in a minute or two. You're on mute, Tindra, I think.
Sorry. Yes, thank you so much again for joining us today. Just to say, this is being recorded. We will be sending out the recording. Just allow for a few weeks though, because we will be adding subtitles, captions, upload on YouTube. So it's not a straightforward sending you the recording. So a few weeks, and it will come to the email you registered to the webinar with. And also to reiterate, this webinar is in support of our Oxford Real Estate Programme, of which Professor Andrew Baum is the Programme Director, so he'll be there for the whole week. It's a 5-day executive programme on campus. Sabina Reeves also teaches on this programme regularly. Yeah, so if you are looking for a programme on real estate investment strategy, this is a great programme. If you're looking to reshape your real estate strategy for the next 5 years and build a resilient portfolio. Also, we discuss current challenges and opportunities of the real estate sectors, topics like ESG, innovation and prop tech, analyze the macroeconomic trends, and also look at a series of case studies. If you're also looking at and coming up or setting up a real estate fund, we also have a group activity during the week where you are working in small groups and coming up with a fund, real estate fund or venture, which you then present back to a panel of investors on the last day. And final, but not least, is the great opportunity to really build an amazing network with professionals, with the faculty as well, the speakers. We have quite a few alumni on this webinar today, and they are probably, the best to say. This is a very diverse cohort of people. Participants come from all over the world, 20 plus countries, and also come from different parts of real estate companies, REITs, real estate developers, fund managers, family offices, insurances, pension funds, sovereign wealth funds, as well as banks and lawyers. So you can find more on the website, and then if you go on the next page, there are some our contact details, my contact details. You can reach out to me if you want to hear more about the program. Find me on LinkedIn or on the page. That's my number as well there. And also relevant to this, as we spoke about value and prices, we also have the Oxford program on valuation of private assets, where obviously we deep dive onto valuation of private classes, and one of which will be dedicated to real estate, and Andrew Baum leads that discussion on that day as well. So yes, please do reach out if you want to hear more. And I think Andrew put his email address at the bottom of this page as well, should you have any questions about the webinar today. So with this note, thank you so much, and I hope to be in touch soon.
Thanks, Dinara. Bye, everybody. Thank you. Thanks, Sabina.